Eric Jackson joins us today. He is the CIO of EMJ Capital. We'll be getting his outlook on the markets, tech overall, and spoiler alert, he's bullish. Welcome to the show. Good to see
Thanks
you.
for having me, David.
I saw you on CNBC not too long ago, and I'll just quote your interview there. You said that the market is entering what you call an everything rally. You said that this is reminiscent of the early days of the 1982 bull market, which is one of the stock market's best performing advances of all time. This is somewhat of a different take than what I'm used to hearing, which is that we're in the middle of a tech bubble. So curious to get your take.
Well, in terms of bubbles, I mean, I think we've been so scarred by the dot-com bubble from 25 years ago now, and then the housing bubble in 2008, 2009, and then, sort of the COVID and everything. I think people are now a little bit too quick to want to label anything that shows signs of life as a bubble. And I think that's sort of what's happening here. I remember a long time ago it was like 2009, I was like touring around in China with a couple of colleagues of mine, and we went to the Wall Street Journal offices back then. And this is 2009. Okay, so like we were like sort of months removed from central banks around the world rallying around saving the economy and everything. And even back then, I remember having this long conversation with all these top journalists over there, saying like, "Isn't this just a bubble? Isn't this just about to explode? Like, it can't go on like this forever." And we were, maybe, I don't know, 5 months into this rally or something. So I think rallies can go on for a long time. I would say we're sort of like 2 years removed from like the market really bottoming out in October of 2022, or for some stocks, it was like December of 2022. And there's no question that we've had a good run, and it's more difficult to find screaming buys today than it was maybe a year ago or 2 years ago. But I do think like there's a possibility that now we're lowering interest rates. Now, the central banks around the world, including China, hopefully, are being very supportive. So there's no reason to me why this cannot go on for several more years. And so I think sometimes you just have to find the best companies that you can and not overtrade them. Just sort of, buy a position and kind of sit on your hands, which is sometimes difficult because there's always some, headline or Tokyo Black Monday, which happens and makes us think that the world is ending. But you just look at a stock like NVIDIA. It's had a lot of volatility this year, but here we are within a few bucks today, as we record this, of the all-time highs that it hit back in June. So, sometimes you just sort of got to take a chill pill and just go with the flow. And I think the flow for now is still upwards.
So back to your 1982 comparison. This is a chart of the S&P 500. This just shows the 80s. So if we were to take the bottom of 82 all the way to the top of 87 before Black Monday, that's a 200% increase in the S&P 500 over the last or over that period of 5 years. So what happened then, and how is that era similar to what's going on today?
Well, the real similarities are that just ahead of that market bottom, we sort of had the peak in interest rates at that time, which was a lot higher on the 10-year than what we've experienced. I think it peaked out at around 13%, the 10-year at that time. And so
Yeah.
you had mortgage rates that were in sort of the high teens. And, we've heard stories from our parents about how expensive mortgages were back then. But you had, years and years of inflation. You had sort of the oil shock that was going on. You had skepticism about things sort of settling down. There was like all these strikes, like the airport, workers unions were on strike and so forth. So there was a sort of a question of can the free market still work? And then you had a yield an inversion of the yield curve, which we've experienced for the last couple of years. And what happened is that once in that sort of, I think it was August of 1982 period happened, the yield curve finally de-inverted, i.e. it went positive. And at that same time, long-term interest rates started to go down and the market started to rally. And so we have many of those things similarly in place today. We finally have Yield curve, even though it's sort of bumped back up in the last couple of days, it's definitely down from I don't know, 3, 4 months ago.
Yeah.
You have this de-inversion of the yield curve. You have sort of this feeling that things are kind of getting back in order. And so I think that can signal sort of an all clear for a lot of stocks. Even though the Mag 7 stocks have obviously done well over the last couple of years, especially, and specific names like NVIDIA, there's a lot of small to mid cap names that really haven't participated. A lot of names in the Dow or the S&P that haven't participated. We've seen since Jackson Hole in August, there's been more strength in the S&P and Dow than there has been in the Nasdaq. But we haven't seen the small caps of the Russell 2000 really participate. We haven't seen a lot of biotechs doing well since the Jackson Hole meeting, and China stocks have sort of been out of commission, with the exception of some positive announcements at the end of September. So there's a chance that now we could be in for this sort of everything rally if we get some support from China. If this rally broadens out to the small and mid caps, that could be add some additional juice to kind of just light a fire under the whole market and see all stocks sort of rising with the lifting tide.
Are you liking the video so far? Well, before we continue, let me tell you about an innovative way to create videos, which I can tell you from personal experience can be challenging and time consuming. Today's sponsor, NVIDIA AI, makes the process incredibly simple. Whether you are a content creator, marketer, or business owner, NVIDIA AI transforms your ideas into polished, professional quality videos in just minutes. It's the world's most used AI video creator with over 10 million users across 150 plus countries. All you need to do is type out a text prompt. From there, you can get creative and fine-tuned ideas for your videos using just text commands. It's like having your own video editor on standby. And the best part, you can clone your voice and make it narrate the videos in your own voice in any language. It does the job of more than 10 tools packed into one and costs just $20 a month to start with. Scan the QR code on the screen here or use my code link down below to get 2 times the video generation credits in your first month. Okay, I want to come back to your everything rally and what exactly is going to rally in just a minute. But just looking at this chart, just to play devil's advocate here now, Eric, the 10-year yield, which is the purple line here, went from 15.7% all the way down to its lows of 7%. Now, we don't have a 15% 10-year today. In fact, it's not even 5. So we have to take into consideration that we don't have as much room to go down. Is that going to be enough to push stocks up to the same kind of extent as the early 80s, though?
Yeah, I think that's a good point. Like, there's not this sort of same tailwinds for like 40 years of kind of continuing declining kind of long-term interest rates fueling the market rally. We're not in that same kind of situation. I agree with you, David, but I would say that we are in a situation where governments around the world, have enormous debt loads. They have aging populations. They have to find ways of sort of financing that debt. And coming out of this period post-COVID, it's certainly in their interest to see interest rates, generally decline around the world. And so going from the levels that we've been at for the last couple of years, down a couple of percentage points, that's going to be helpful to a lot of governments. And I think, that additional easing is also going to be supportive of asset prices in general, including stocks.
So here's the 10-year yield again. Fast forwarded to today. Earlier this week, bit of a rally on the 10-year, especially yesterday when the inflation numbers came in a little bit hotter than expected, Eric, although the year-over-year CPI is still down from the previous month, 2.4% versus 2.5%. Now, is the Fed going to look at this and say, well, it's time to put a pause on cutting rates next month at the next meeting? Keep in mind, we also had a good jobs report the previous Friday.
I think I think the key is that there's a lot of noise sort of month to month or even week to week, with depending on what the measure is that we're focused on getting released. But like you say, like the year-on-year measure did decline again earlier this week. We're obviously kind of in this continued easing from of inflation overall. Really, the only thing propping up inflation in the U.S. or in a country like Canada, where we are, is this owner's equivalent rent. And basically, as these long-term interest rates continue to move down, that's there's going to be this sort of lagging effect on continuing to ease the overall inflation rate. So I think it's sort of baked in the cake that we're going to continue to see interest rates decline. We've only just started. Canada's dropped 75 bips so far. The Fed caught up with its 50 bip cut.
Mhm.
Do they continue with 25 bip increments, or do they take a break here or there? I don't think it really matters. I think the trend is going to continue to go down, and overall, that's going to be supportive of stocks.
Now, it's interesting because the last two times the Fed cut by 50 basis points, it was during the middle of a crisis. So 2008, 2001, and those were very obvious economic catastrophes. That well, actually, 2001 wasn't even an economic catastrophe, but we were in the middle of a tech bubble burst. Nothing
Mhm.
of that sort is happening today, yet they still
No,
cut by 50 basis points. Why?
just because they've been high for so long, while this economy has sort of been well, it's hasn't been contracting, at least not in the US, but the real interest rate levels have been lower than the sort of the posted 10-year long-term bond rates for a good year now. And so we've been sort of tighter than conditions warranted for a while. And that's why, or that's the reason for that, is that the central banks, including the Fed, have wanted to see the kind of the whites of the eyes of inflation as truly like rolling over and kind of being at or below kind of the 3% level, and then now the 2% level. So now we're clearly there. They are catching up, I guess, or the Fed was at least, to probably where they wish should have been already, by maybe doing a 25 bip cut in July. So I think now they're still behind the curve in the sense that the economy is slowing, although it's certainly still got a lot of gas in the tank, it seems, in the U.S. But like the real conditions, I guess, warrant lower interest rates from where they are here. But we'll see how fast they are in a hurry to move to get there.
So when you say everything rallied, do you mean everything, including other assets besides stocks? Are we talking about bond rallying as well, which is what happened this year? We talking bonds did well this year, as well as stocks, right? Real estate. Are we talking about real estate, commodities?
Yeah, I think, I mean, I'm talking about like the major assets, current, commodities, real estate, stocks. As interest rates subside, that's supportive of commodities. That's going to be supportive of real estate activity, both in the States and Canada, which has been kind of dormant for the last 6 to 12 to 18 months. So yes, I think this, to this point, like it's really been a handful of stocks, which are the largest stocks, these sort of so-called Mag 7 stocks, that have really held up the markets in 2023 and 2024. But there were a lot of stocks that the multiples and the valuations were still kind of, not that, much improved from their post-COVID lows. So, I see a broadening out, to multiple sectors, not just in technology, and definitely towards sort of the mid cap and smaller cap end of the scale for stocks participating in this everything rally.
So, like I pointed out earlier, the period of 82 to 87 saw a more than 200% increase for the S&P 500. What conditions would need to be in place for that to happen again today? Keep in mind that the S&P and Nasdaq have already run up considerably since the pandemic.
Yeah, I mean it's hard to predict that far ahead because obviously there are big differences between our economy today and what it was like back then, and the fact, like you mentioned before, that we were just sort of at the beginning stages of this sort of going from 15% tenure down to effectively zero over 40 years. However, one thing that caught my eye when I went back and looked at that period is that when the rally in the S&P 500 and the Nasdaq first started in August of 1982, when you had this sort of de-inversion of the yield curve, you got basically a 10-month rally after that, so almost a year, where the Nasdaq itself rallied 106%, and the Nasdaq back then it was didn't have sort of the same kinds of very small, smaller cap tech stocks. It was sort of, bigger, more established tech companies. And so smaller cap companies tend to rally more than obviously mid cap or large cap companies. So, you know, if we saw 100% rally in the Nasdaq today over the next 10 months, what does that mean for, like an ETF, like an ARK or some of these smaller cap tech growth names? I think, they're going to rally more than 100%. Is it going to be 200, 300, 400%? I mean, I don't know, but there's going to be possibilities in names like that. I mean, I really am interested in some of these Chinese names. I think the whole China market has been sort of like dead and dormant basically since Xi took over. There have not been very market friendly policies coming out of the Chinese government, and so we got the first hint of those in late September. And there's some speculation like this coming weekend after we're recording this discussion, that there's going to be some new announcements about stimulus directly into the Chinese economy to support consumers over there. I mean, if we get those kinds of really supportive policies, economic policies from the Chinese government, a lot of those stocks, are trading at like 80% lower than where they were at during 2020 or 2021. A stock like Alibaba has had a great run off of like, I think it hit a low of like $58 a year ago. It's up to like over $100 today, but it's still like 70% below the highs that it traded at in 2021. So a lot of international investors have just gone out of names like that, the Chinese names. So I'm eyeing that market in particular because unlike some kind of more expensive stocks here in North America, if we truly get some really strong supportive policies over there in China, I mean, I think there are some names over there that could rally 5, 6, 7x over the
Would
next
that
few months.
would strengthen the Chinese markets from Chinese stimulus translate over to North American markets?
That has happened, before. If you go back and a lot of these Chinese stock names, like it's they're among the most volatile in the world. It's sort of feast or famine in terms of investor interest in them. But when there is this, FOMO starts to kick in, and you see some of these names like double, triple, 4x, 5x. It does seem to anyway. There's a correlation between success in those kinds of equities and then what tends to happen in the Russell 2000 over here and some smaller cap names. So maybe people are cashing out profits that they get from the exposure to Alibaba and Pinduoduo or whatever, and they're plowing it into some American names over here. But it does appear that yes, it's sort of synergistic. That and so if we do get some support in the Chinese equities, it spills over into Hong Kong equities and stuff in the rest of Asia, and then over here in North America.
You told me offline that there is a relationship between inflation and tech stocks, which is an area of focus for your fund. Tell us about this relationship.
Well, interest rates at the end of the day, fund startups, and so all startups start with no profits. And so, whether if you're a biotech company, you're probably not going to even generate revenue for years and years once you put a team together and you start. And so you need to go out to the market and borrow money. And it's the same for tech stocks. It used to be the case that after a couple of years, most tech stocks were aiming to generate profits. As time has gone on and as the cost of capital has sort of gone from that 15% level to like 0%, it's become more fashionable for a lot of, tech startups, whether it's, a Facebook or ByteDance or whatever, to kind of push, now OpenAI, push profitability out, years and years into the future. So when interest rates went to zero post-COVID, that's why you saw after the initial shock of like, the global economy is shutting down in sort of March 9th or March, 15th timeframe. By the end of March, when the Fed had come in and suddenly dropped interest rates to zero, you saw stocks that basically sort of dropped, 40, 50%. Suddenly, by the end of March, going out of that month higher than sort of where they were coming into the month. So they'd made back all their losses, and then there was a slingshot that happened as those stocks continued to rise, and we saw these stocks trading at multiples like you wouldn't imagine. That was all pegged off of this kind of 0% interest rate. So when the party ended and we realized that inflation wasn't just transitory and it was going to be here for a while, and central banks got on their horse, jacking up interest rates, that's the first stocks to really show the effects of that or to crash were the least profitable tech stocks. And they peaked out in about February of 2021. It was the rest of the market, including like all the Mag 7 names, they didn't sort of hit a peak until probably November of 2021. So basically that sort of shows you the direct correlation between, if inflation rates drop, it's these least profitable companies that respond fastest and move up the fastest. If they go up, they're going to get hit first and kind of be affected the most. Now we're coming to the other side. The least profitable companies in the NASDAQ really haven't done all that great over the last couple of years, even though we're sort of 2 years into this rally. And so I'm waiting, and I think a lot of people are waiting to see, when the drop in interest rates really starts to take hold for names like that, and they start to participate again and start to move up again.
If you take a look at the relationship between the Russell and the NASDAQ, for example, take a look at my screen here. Over the last year, the Russell has underperformed. Now, some skeptics of a bull run would point to this chart and say, well, look, if you strip out the Mag 7, which have contributed to a large portion of the gains of the NASDAQ index over the last year, you're looking at something similar to what the Russell did, which is just, kind of up but flattish over the last year. The relationship is, if you zoom out, it's the same thing. So if we just take a look at how the Russell has performed, can you make the argument, Eric, that the stock market really isn't that strong because most of the gains in the NASDAQ have just been due to a handful of names?
Yeah, I would absolutely make that argument, David. You know, I, you sometimes hear people say that, oh, we're in a bubble because like these Mag 7 names, these big technology names are all that's carrying the market. And so there's sort of like two arguments that are being made when you hear people say that. One is they're trying to imply that the names of, Netflix or especially NVIDIA or Apple or Facebook or whatever, they're overvalued and they're kind of in a bubble. I don't think that's the case. But second, they're saying like these names are the ones that are propping up the market. I guess I would agree with that in the sense that these stocks are so big now therefore they constitute so much of a weighting to the overall whatever it is, Nasdaq or the S&P 500, that there's no question that they're influential. So if they go up, they kind of pull the index for the market up, but they deserve to be as big as they are. We've never seen stocks like these as profitable as these. They almost run on like an annuity, like a stock like an Apple. Even though we don't have a formal contract with Apple, many of us have contracts with our carriers. How many of us are really going to stop buying Macs or iPads or iPhones for us or our kids and stuff like that? It's sort of a long-term subscription that we have. So they're fine and they're going to be fine for a long time. Are they propping up the market? Yeah, they're so profitable that inflation kind of really means nothing to them, unlike a lot of these smaller stocks. But like you say, so I think their performance has been deserving. I don't think they're in a bubble. If you look at a lot of their multiples, they're more expensive today than they were 2 years ago. But a
Mhm.
name like NVIDIA, for example, relative to where it's traded at in the last 5 years, if you take a metric like a forward price earnings multiple for an NVIDIA, I think it's still below the average of where that multiple for NVIDIA has traded at over the last 5 years, and I think the reason is that folks are just kind of skeptical that the results have been so good over these last year and a half, 2 years. How can they just keep it up? How can a company just continue to, post billions and billions of
Right.
dollars, and so, but it's not expensive, like on a multiple basis. So, but back to the point about like how about the rest of the market? The rest of the market really hasn't, in large part hasn't participated in this 2 year rally. So I think if we continue to, see this broadening out occur, if lowered interest rates are supportive of some of these names doing well because their cost of capital is going down. If suddenly the Chinese names are on fire over the next few months and
Yeah.
people are richer because of that from investments over there, and then they plow those profits back into some of these other names, yeah, you could suddenly see, this could be the beginning of a new 2 year rally for the rest of the market and not just the
Well,
Mag 7 names.
that begs the question as to why capital would rotate out of the Mag 7. I mean, if it's been a sure bet up until now that I could just bet on blue chip tech stocks and outperform the rest of the market, why wouldn't I stick with that, right?
Well, this year is interesting because like there's some names like Microsoft, a couple of days ago at least, was only up 11% year to date, which is fine. I mean, but it's less than what the Nasdaq has done.
Yeah.
And you'd be kind of surprised because for it's basically been flat since February. It sort of had that 11% appreciation from January to
Right.
February. And then it's sort of like now we're in the same spot here, whatever it is, 9 months later. And so, and yet, all we do is we talk about AI and AI is a bubble. Well, what are the stocks that are driving AI? Obviously, it's NVIDIA, but you'd have to say Microsoft is tops on the list after NVIDIA in terms of a stock that you would think should be participating in the AI rally. So if this is truly an AI bubble, which I don't think it is, as some people say, you would think Microsoft must be in a bubble, and yet this is a stock that has done nothing since Feb 1. So I think there's been some consolidation amongst some of these Mag 7 names. And that's healthy. And that shows that there's been some rotation of profits from before, from 2023, perhaps when Microsoft had a bigger year, where it has moved around into other areas as well.
Well,
So,
let's just take a look at NVIDIA for a minute, since we
yeah.
talked about that. Why has the momentum stalled ever since June?
There's been concerns about the latest generation of chips that are going to be start shipping in their Q4, um, and or were there going are there technical production delays? Is that going to delay the adoption of those chips, which cost more and are more powerful? And therefore, is revenue growth going to slip out into the future? I mean, that definitely gripped the company going into their last earnings, which got reported in August. And so, and leading up to those earnings, there was a concern. Wow, this stock has really had this enormous run from, I think it was like, in the 70s at the end of 2023. And then suddenly in December and January of this year, the thing sort of took off and on its way to like 140 by June. And there was sort of like this natural pullback. So, um, in my view, NVIDIA still undervalued, still a great stock. It's one I own. I think there was nothing wrong with this, the Blackwell chips that are going to be coming out in Q4. They're already saying now there's like a 12-month waiting list for, they're sold out basically for the first 12 months after they start shipping those chips. So I think it's still undervalued. And I think the stock goes higher from here.
Well, you mentioned that tech is not in a bubble. The assumption, I guess, is that the earnings are justified, and at least the forward earnings that people are projecting are going to be justified. What will pull forward these higher multiples in the future?
I think it's, if we start seeing that, other areas of tech, like whether it's Chinese tech or the Russell tech, or sort of mid-cap companies, or SaaS companies. Like if you think of names like Salesforce, Adobe, Okta, up until maybe just in the last week, these names were like terrible, amongst the worst performers. They had run up significantly like into the COVID bubble. And yet, names like Okta, I don't know, HubSpot, MongoDB, they couldn't like, catch a bid at all. There seemed to be no interest in these kinds of names. So if suddenly you start seeing, oh, these names are now participating, the IGV, which is sort of like the software ETF, is now fully participating. The old ARC names, like which are sort of like a almost like a catchphrase for the less profitable parts of tech, are suddenly participating again. If the biotech ETF XBI suddenly starts ripping higher, then then there's FOMO. Then people are talking, and money starts flowing back into the market in general, and then the rising tide helps all stocks. So I think those are the things to watch for if there is going to be another leg to this rally, as I think there will be.
Eric, what could, in theory, change your mind about a rally? Anything that could derail this forecast?
Well, I think in a country like Canada, the underlying economy is really weak, and so and outside of the U.S. and parts of Europe, things are not great. And that's the reason why interest rates are dropping, is that people are no longer like doing renovations to their houses and additions like they were in the COVID days. And so people are nervous about their jobs, keeping their jobs, and so forth. So I think if that suddenly took hold, something like that took hold in the U.S., that would really kind of destabilize things globally in the overall market. And so then we sort of moved from a place where maybe a year ago, bad economic news or increased job losses would have spurred a rally that day in tech stocks, because people would have concluded, oh, the economy's doing worse, therefore the Fed's going to have to cut sooner, and that's great. So the bad news is going to drive tech stock prices higher. We're now in a situation where if there were signs that like the economy is really slowing, that would negatively affect all stocks, including tech stocks, because people would worry that something stalled out here in the economy, and the Fed's going to have to move faster. And before we get to better days, we're sort of like in this stall speed, with the economy, and that's just there's going to be kind of like a short-term drop in asset prices to reflect that before we come out the other side and they start to climb up again.
I do wonder whether or not big tech companies, not the smaller names, but the big tech companies are more or less recession proof now. I mean, just take Microsoft, for example. A large chunk of the revenues come from cloud services, subscription services to Microsoft. Are you really going to cancel your Microsoft Office subscription during a recession?
Yeah, I agree. I mean, a lot of them are. I mean, same with Apple, Google. We had these announcements earlier this week about if the FTC was going to come after them, or the DOJ, and try to break them up in some fashion. So, I mean, that they move with that, but they are so big. YouTube is going to continue to grow. So a lot of them are in their own orbit, and very little is going to slow them down. But if there is a slowing in the rest of I mean, the one stock that would send a shock waves through not just tech, but stocks in general, would be NVIDIA. If they suddenly laid an egg, in an upcoming quarter, and they just their deliveries were like way below expectations, I think that would really stun people. I don't expect that to happen. But I think that would have, would pull down all stocks if there was something like that. So because that's probably still the most important stock in the universe today, and because of all the interest in AI and everything. But as I said, I do not expect that to happen.
Very good talk. Thank you very much, Eric. And where can we learn more from you?
My website for my company is emjcapital.ltd, like limited. You can find me on Twitter at Eric Jackson. and other social media. So look forward to staying in touch with folks. And thank you, David, for having me on.
Yeah, thank you for joining the program. We look forward to having you back again. And thank you for watching. Don't forget to like and subscribe.